Welcome to our next in a series of lectures related to accounting information. In this lecture, we're going to be focusing on the financial statements. The financial statements are prepared by accountants for the use of external users. As we go through the financial statements, we need to identify what the financial statements are, how they interrelate with each other, and the purpose and use of each of these statements. There are four specific financial statements. The first financial statement is the income statement, or the statement of financial performance. In the statement of financial performance, we are measuring activity during the period. We are measuring the revenue for the period. We are measuring expenses for the period. Revenue minus expenses gives us net income. Net income provides the answer to the question, how much did we make during the period? Let's now talk about the next statement, which is the statement of stockholder equity. In the beginning course of accounting, we focus on two elements of the stockholder equity. The first is contributed capital or common stock. This represents the amount that owners have contributed to the business. The second classification within the stockholder equity section is retained earnings. Retained earnings represents the retained net income to the organization since its inception. It represents net income minus dividends distributed. As we've discussed, dividends represent a distribution of earnings to the owners of the organization. The stockholder equity section is a report of change in financial position, which means that we report the beginning balance plus or minus any changes and then the ending balances. The two changes that we'll talk about in this course represent the additional contributed capital and any changes to retained earnings, which represents the addition of net income minus dividends paid during the period. The third financial statement that we discuss is the balance sheet. The balance sheet represents the assets, which are resources, liabilities, which are debt, money that we owe to other organizations, and stockholder equity. You notice that the statement of stockholder equity is completed before we complete the balance sheet. It is the information from the statement of stockholder equity that then is embedded in the balance sheet, and this piece represents our equity within the organization. The final financial statement that we discuss is the statement of cash flow. The statement of cash flow identifies cash inflows and outflows to the organization during the period and reports change in cash as compared to the beginning of the period to the end of the period. The statement of cash flow is divided into three areas. The first area is cash flow received from operations. The next is cash flow from investing. And the final component of the statement of cash flow is cash flow from financing. The change in cash in the statement of cash flow should reflect the difference between last year's ending balance and this year's ending balance of cash that is reported in the balance sheet. Now that we've provided a brief description of each of the four financial statements, we will now go into the detail of each of these statements and present these in the way that we will be completing these for the completed financial statement. The first financial statement that we complete is the income statement. And the reason we need to complete the income statement first is because the net income, which is the result of the income statement, then flows into the statement of stockholder equity. Let's talk specifically about the income statement. Income represents revenue minus expenses. You notice here we have sales or revenue. You may see this as fees earned in a service organization. we have revenue of $6,644. We then list all of our expenses. The first expense is cost of sales. You may see this as cost of goods sold. In addition, we have selling and administrative expenses, interest expense, income tax expense, and other expenses. We sum the total of our expenses, and this is $5,983. You notice in accounting, we put this in parentheses, signifying this as being a negative number. We then report net income. Net income is simply revenue minus expenses. We are reporting revenue and expenses during a specific period. This specific period could be a month, a quarter, or a complete year. Let's now move our attention to the statement of stockholder equity. We're going to focus on the two columns, common stock and retained earnings. For the purposes of a beginning class in accounting, we're going to dispense with the discussion of other items. You notice that the rows are balance as of January 1st. This is last year's ending balance. Changes to retained earnings from net income and dividends are reported. These changes are what occurred during this period. And then finally, we report the balance as of the end of the period. In this case, it is December 31st. Let's talk specifically about common stock. Again, common stock represents the amount of contributed capital to the organization. In this case, we started off with $360 in contributed capital. There were no other contributions during the period, so at the end of the period, we end up with a balance on December 31st of $360. Let's now focus on retained earnings. We start off with a balance of $4,708. Keep in mind that this represents the retained earnings of the organization since its inception. And again, what are retained earnings? Retained earnings represent net income minus dividends distributed. During this period, we have a net income of $661. That $661 came from the income statement. Thus, the point that we made that you need to complete the income statement before you can complete the statement of stockholder equity. During the year, there was a distribution of dividends of $341. Dividends are distributed to the owners of the corporation. The board of directors are the ones that actually authorize the distribution of dividends. Note that we're not distributing all of our earnings to owners of the corporation through dividends, but we retain earnings. Thus, we have the retained earnings, and again, the balance of the retained earnings is the beginning balance plus net income minus dividends distributed gives us the retained earnings for the end of the period. Now that we have the balances for common stock, retained earnings, and total, we can then complete the balance sheet. And you will notice how these numbers actually cross over to the balance sheet. Let's now focus on the balance sheet. The balance sheet is called the balance sheet for two specific reasons. One of which is we are reporting balances of each of these accounts at a specific point in time. This is what we call the statement of financial position. So as of December 31st, these are the balances of each of these accounts. The other implication of a balance sheet is that the financial statement is in balance. What we mean is that assets equals liabilities plus stockholder equity. Let's focus on specific elements within the balance sheet. Assets represent resources that are owned by the organization. You notice how these resources are reported in order of liquidity. Liquidity represents the ability to convert to cash. So obviously the first item is cash. Accounts receivable represents money that is owed to us from customers. We have an accounts receivable when a customer buys something from us on account. We are expecting to get paid. Inventory represents the goods that we have that we expect to sell. We've talked about prepaid expenses. As an example, a prepaid insurance expense is the insurance that we pay in advance. If we pay this in advance, we have an asset. And as time passes, which is the function of an insurance policy, this asset then converts into an expense. Other items, such as property, plant, and equipment, are long-term assets, meaning there is not an expectation that we're going to be converting these to cash anytime soon. Let's now focus on liabilities. Liabilities represent what we owe. Accounts payable is the first item that's listed. Accounts payable represents the money that we owe to vendors. Accounts payable is the mirror image of an accounts receivable. In an accounts payable, we are buying something on account. So we owe the money to the vendor. The vendor's reporting the accounts receivable. We are reporting the accounts payable. We then have items such as accrued liabilities, notes, and other debt. We are reporting liabilities in order of the time that we expect to have to pay these back. Generally speaking, accounts payable is the amount that we need to pay first within the list of liabilities. Finally, we have stockholder equity. The two accounts that we're going to be talking about in this course is capital stock, or our contributed capital, and retained earnings. Now, you notice that assets are $4,754. Liabilities plus stockholder equity also is $4,754. So this account is in balance. The elements of retained earnings, capital stock, and total stockholder equity are the numbers that have been transferred over from the statement of stockholder equity. As we have talked about, it's important that we complete the income statement first. We then complete the statement of stockholder equity, and finally we complete the balance sheet. Since we're going to be spending more time on the statement of cash flow later on in the course, I'm going to spend a little bit of time now to explain the statement of cash flow. The statement of cash flow is divided into three specific areas. Cash flow from operations. This represents the cash that is generated from our day-to-day activities of revenue and expenses. We then have cash flow from investing. Cash flow from investing represents the amount of money that the organization pays for assets and the amount of money that the organization receives when it sells assets. Keep in mind that buying assets represents a long-term strategy of the organization. As it buys equipment and buildings and other items, they are looking forward to activity beyond the next year. So it's very possible that cash flow from investing would be a negative number. And in fact, that would be perceived as a very positive sign for the growth of the organization. Finally, we have the cash flow from financing. Cash flow from financing represents activities associated with long-term debt as well as equity. The two elements of equity that we've talked about is contributed capital that you would see in the financing section, as well as when we pay a dividend, this represents a cash outflow from financing. This concludes our presentation of the four financial statements. I thank you very much for your time.